Jenna, this module feels deceptively small. You look at the outline and think, oh, it's just dividends and stock splits. Then the FAR exam says, great, let's see if you actually understand equity.
Exactly. This is one of those modules where memorization gets people into trouble. Nearly every topic asks the same question in a different disguise. What actually changes shareholders, equity, what simply rearranges it, and what doesn't change it at all? If you keep that mental map in mind, almost everything else falls into place.
So today's mission isn't to memorize journal entries, it's to build one picture in our heads. Imagine shareholders' equity as one big pie. Some transactions make the pie bigger. Some make it smaller. Some just slice it differently. Some don't even touch the pie, they just give people the option to buy another slice later.
That's a great framework. Every topic today fits into one of those categories. Whenever you're confused, ask yourself one question. What actually happened to the equity? Not what paperwork was signed, not what management announced, what actually happened to the ownership section.
Let's start with stock issuances to non-employees. My first reaction is, wait, why are we paying someone with stock instead of cash?
Because sometimes companies compensate suppliers, consultants, attorneys, or other parties with shares instead of cash. Becker specifically introduces stock subscriptions and stock rights as part of these equity issuance concepts. One important thing to notice is that promises and opportunities aren't the same thing as issued stock.
That sounds obvious until the exam tries to trick you. It's like saying, I reserved a seat at the concert. You don't actually have the ticket yet.
Exactly. A stock subscription is essentially a contract to buy stock at a future date. Think commitment first, ownership later. The commitment exists before the shares actually become outstanding.
So don't jump ahead mentally. The contract isn't the stock. It's the promise that eventually leads to stock.
Exactly right. Now let's move to stock rights. Becker gives one sentence that is incredibly important. Existing shareholders receive the opportunity to buy additional shares. Notice the word opportunity.
That's almost like getting first dibs on concert tickets. Nobody forced me to buy them. Nobody automatically charged my credit card. I just received the chance.
Perfect analogy. And here's where it breaks down just a little. Concert tickets disappear if you don't buy them. Stock rights are about protecting existing ownership interests by giving shareholders the chance to purchase additional shares before outsiders do. The important accounting point from Becker is that these rights do not affect equity until they are exercised.
That phrase sounds extremely testable. Until exercised, meaning nothing has happened yet.
Exactly. Whenever you see stock rights, pause before assuming equity changed. Opportunity does not equal transaction.
Now we're getting into dividends. And this is where everyone starts mixing everything together. Cash dividends, property dividends, stock dividends, stock splits. They all sound like ways of giving shareholders something.
And that's why understanding the purpose matters. A dividend is a distribution to shareholders. But different kinds of distributions affect equity differently. Let's start with the simplest. Cash dividends.
Company has cash. Shareholders want cash. Company gives away cash. Seems pretty straightforward.
Exactly. Becker emphasizes that dividends declared reduce retained earnings on the declaration date. That's a huge point. Notice it doesn't say payment date, declaration date.
Interesting. So, management making the official decision is what reduces retained earnings, not the day everyone actually receives the money.
Correct. That timing catches people because instinctively they think cash leaving the company is the important event. Accounting says the declaration creates the obligation. That's when retained earnings decreases.
Okay. Now, property dividends sound similar. Instead of mailing shareholders cash, we're mailing them stuff.
Essentially, property dividends distribute non-cash assets instead of cash. But Becker highlights something that makes them different. They're recorded at fair value on the declaration date. Any gain or loss is recognized at that point.
So, unlike cash, the company first has to recognize what that property is actually worth.
Exactly. The accounting first reflects the asset's fair value before distribution. That's why property dividends create an extra layer compared to ordinary cash dividends.
Now, the famous stock dividends. This is where everybody starts guessing.
And Becker gives you one beautiful shortcut. There are two categories: small, large. The breakpoint is 20 to 25% of outstanding common stock. That's worth remembering because the exam loves asking whether something falls above or below that line.
Why even have two categories? Couldn't they just all be stock dividends?
Think about magnitude. A small stock dividend isn't changing ownership very dramatically. A large stock dividend starts looking much more like a restructuring of the ownership interests. Because of that difference, the accounting treatment changes.
Here's an analogy. Imagine slicing a pizza. If I cut one extra slice into an already large pizza, everyone basically has the same pizza. If I suddenly double the number of slices, people start thinking about the pizza differently.
I actually like that. Where it breaks down is that no additional pizza appears. The company hasn't become more valuable. Only the ownership units changed. That's the key idea students sometimes miss. Stock dividends don't magically create wealth. They redistribute equity.
Now, Becker says small stock dividends are recorded at fair value. Large stock dividends are recorded at par value. That sounds like exactly the kind of sentence the exam expects you to remember.
Yes. Instead of memorizing isolated rules, connect it back to the idea that small and large stock dividends represent different magnitudes of ownership redistribution. That's why the accounting differs.
Then comes the topic students accidentally merge with stock dividends. Stock splits.
This distinction might be the highest value concept in the entire module. Becker says stock splits require no journal entry. No journal entry. That's incredibly important.
I love that because it's almost suspicious. Accounting loves journal entries. Then, suddenly one topic proudly announces, nope.
Exactly. And Becker also says the total book value of common stock remains unchanged. Think about what actually happened. The number of shares changes. The ownership percentages stay the same. Total value doesn't suddenly increase.
So, here's my analogy. Imagine exchanging one $100 bill for two $50 bills. Did you become richer? No. You just changed the denomination.
That's probably my favorite analogy so far. Because that's essentially what a stock split accomplishes. More shares, smaller ownership units, same total ownership, same overall value.
Let's compare. Cash dividend. Company gives away assets. Property dividend. Company gives away non-cash assets. Stock dividend. Ownership accounts get rearranged. Stock split. Ownership units change without changing total value.
Exactly. Notice how each one answers our original question differently. What happened to equity? That's the organizing principle.
Something else that helps me. Whenever I hear the word distribution, I immediately ask, what exactly is being distributed? Cash, property, additional shares, or are we just changing the number of pieces?
That's a great habit. The exam often disguises questions by changing the wording while testing exactly that distinction.
Now, let's finish with something students sometimes treat like an afterthought. The statement of changes in stockholders' equity. Sounds boring. Probably isn't.
Definitely not. Think of it as the master scoreboard for the equity section. Every major equity account begins with a balance. Transactions happen throughout the period. Then every account ends with a new balance. Instead of looking at retained earnings by itself, or common stock by itself, this statement lets you see everything moving together.
It's almost like watching every player on the field instead of only following the quarterback.
Exactly. One transaction might increase common stock. Another decreases retained earnings. Another affects additional paid-in capital. Instead of viewing those changes separately, this statement tells the entire equity story.
Which means if I understand every transaction we've discussed today, I should be able to predict which columns move on that statement.
Exactly. That's the mental model Becker is trying to build. Equity isn't one giant account. It's several related accounts moving together over time. The statement simply documents those movements.
Let's wrap everything together. Stock subscriptions. Promise first, ownership later.
Stock rights? Opportunity first. No equity effect until exercised.
Cash dividends. Retained earnings decreases when declared.
Property dividends? Recorded at fair value on the declaration date, with any gain or loss recognized then.
Small stock dividends. Think fair value. Large stock dividends. Think par value. Remember that 20 to 25% breakpoint.
Stock splits? No journal entry. Total book value unchanged. Just a different number of ownership units.
And finally, the statement of changes in stockholders' equity isn't just another financial statement. It's the movie showing every equity account changing over time instead of isolated snapshots.
Exactly. If you leave this episode remembering only one thing, let it be this. Every question in this module is really asking the same thing. What changed in shareholders' equity? If you answer that first, the accounting treatment becomes much easier to recognize. And that's exactly the kind of thinking the FAR exam rewards.